Well, good afternoon. Happy Friday. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. It's June the 17th, and as crazy as 2022 has been for the mortgage industry and for interest rates, June has amped it up even more, and we've seen an incredible amount of volatility in just a couple of weeks here in June. We're going to break all that down for you as we go into the holiday weekend. So at the heart of this, of course, has always been inflation, and we hoped that we had seen the peak of inflation back in April, and all eyes were on the June 10th Consumer Price Index report. We were hoping we were going to see the CPI number come in the low 8% range, maybe 8.2, 8.3%. Unfortunately, that inflation report beat expectations, came in higher at 8.6%, and that sent mortgage-backed securities into a free fall. As we've talked about before, red days are bad days, green days are good days. So red day's a bad day. There's June the 10th right there. I'll blow this up just a little bit. June the 10th, that's a pretty big sell-off for mortgage-backed securities in light of that inflation report, and we found new highs for interest rates on June the 10th of last week, Friday of last week. We went through the weekend and we were hoping to see a little bit of bounce back as we started off this week, and of course that definitely did not happen. One of the worst days in the mortgage-backed securities market that we've seen in the past 20 years happened on Monday. Another huge sell-off in mortgage-backed securities Monday. Sold off a little bit more on Tuesday and reaching, of course, highs that we haven't seen for interest rates in quite a while, since maybe 2008. And then we got a nice bounce back on Wednesday, which is counterintuitive because on Wednesday, the Federal Reserve raised the Fed funds rate by 0.75 of a percentage point, a rather big move. 0.75 of a percentage point is a pretty substantial move to be raising the Fed funds rate in one meeting, and you would think you would see interest rates worsen on a day like that. But interest rates actually improved, and we saw the exact same thing when the Fed raised the Fed funds rate by 0.25 of a point earlier in the year. Mortgage rates actually improved on that day, which gives fuel to the fire and credence to the fact that mortgage rates and the Fed funds rate are completely different instruments. Now, they are influenced by the same thing. They are influenced by inflation, and the moves by the Fed are an attempt to get inflation under control. It doesn't seem to be under control yet, and so the Fed makes a pretty hefty move there with a 0.75 of a percentage point increase to the Fed funds rate. Now, that, as you can see, was one of the few good days that we've had. This looks like a relatively calm day. This is Thursday, but it was anything but calm. As a matter of fact, if you can see that thin line there, that tells you the entire day's trading range, which was rather broad. We saw a huge sell-off. We saw a nice bounce back. We saw another sell-off. Then we saw another bounce back and ended the day rather flat. And this is, of course, today, Friday, where things have been calmer. I wouldn't say calm, but calmer as we go into the holiday weekend. So what's behind all this, of course, is inflation. Inflation really comprised of a couple of different elements, many of which are, a couple of these we can't do anything about. Number one is supply chain, of course. We know what's happening in the Ukraine. We know how that's impacting Europe, how that's impacting the United States, Asia. We also know about supply chain issues brought on by the pandemic. We've been talking about that for years, and that's still ongoing, especially as it pertains to goods out of Asia. But the other two factors that we can talk about now are greedflation. If you haven't heard that term before, it was popularized by a New York Times article over the past couple of weeks. Greedflation, where corporates are doing a bit of profit taking in light of these record high inflation numbers, or at least 40-year high inflation numbers. And then the other part of it, the part that probably has the propensity to fix itself the quickest, is the amount of juicing that American consumers experienced during the pandemic. We were getting checks in the mail from the federal government. We could put our student loans into forbearance. We could put our mortgage or our rent into forbearance, didn't have to pay it. And of course, we're not spending money at restaurants. We're not spending money at concerts or on vacations because we were in the middle of a pandemic. And that's when we saw a record savings rate of over 33%. Country had never seen that before. And all of that savings went into this well of American savings, and it's now being spent. It's now being spent at a pretty incredible pace. Matter of fact, let me flip the screen around here and let's talk about the depletion of that savings. The personal savings rate in America just hit the lowest level. This was published on June the 7th. The personal savings rate in America just hit the lowest level since the Great Recession back in 2008. We also can take a look at this post by Michael Burry. Michael Burry made even more famous by the movie The Big Short. He was certainly made famous by that movie and his bet against the mortgage market. He says he's charting the total U.S. personal savings over GDP. The red line, which you may or may not be able to see very faintly down here at the very bottom of his post, was set in July of 2005. That's an all-time low for personal savings at 1.5%. He says at the last 12 months rate of depletion of savings, we could hit that red line, that all-time low, sometime between September and December of this year. And you can see what he's talking about there. Let me see if I can blow this up a little bit so you can see it more clearly. Shoot. There we go. There we go. So you can see we're trending along this line, that if we keep along that line, sometime between September and December of 2022, we could reach the all-time low for personal savings. And you can see his last comment here, borrowing time, right? And then here's another example of the personal savings rate. These are the actual readings. January, we were at 6%, February 5.9, March 5.0, April 4.4. We will not get the May reading until the tail end of this month. So June the 30th will tell us what the personal savings rate was in May. The soaking up of this amassed personal savings is actually a good thing in the short run, because it means Americans are going to be unwilling or unable to pay higher prices. That should take care, at least in part, of this corporate greedflation, this corporate profit taking, hopefully allowing corporations or forcing corporations to drop their prices down and get inflation more under control. Those moves, coupled with the moves by the Federal Reserve, gives us high hope as we move towards the end of this year. Not going to do a whole lot for us in the next 60 to 90 to 120 days, but certainly we hope as we get towards November, December of 2022, we'll start to see that inflation number abate, and that would be welcome news for mortgage-backed securities and for mortgage interest rates. If I can be of any service to you over the holiday weekend, please don't hesitate to reach out. Mark.Milam at highlandmtg.com. Thanks.